In 1982, Ray Dalio stood in front of a room full of investors and told them the American economy was heading toward a depression. He was so certain, he bet everything on it. He was completely, catastrophically wrong. The market did the opposite of everything he predicted, and it nearly destroyed him. Dalio didn't just recover, he used that failure to build something that would correctly predict the 2008 financial crisis years before it happened, while every major bank, every government economist, and almost every investor on earth was blindsided by it. Today, Ray Dalio explains exactly why most investors never see the next crisis coming and the specific things you can do right now to make sure you are not one of them. Enjoy.
I want to start with the most embarrassing moment of my professional life because I think it is also the most instructive one, not just for me, but for every investor trying to understand why crises blindside the people they blindside. The year was 1982. I was 33 years old. I had spent the previous decade building Bridgewater from nothing, starting in my two-bedroom Manhattan apartment with nothing but a telephone, a telex machine, and an obsessive need to understand how economies actually work. By 1982, I had developed what I believed was a sophisticated model of the global economy. And that model was telling me something that I was absolutely convinced was true. America was heading into a depression. I was so certain that I went on television and said it publicly. I testified before Congress about it. I told anyone who would listen that the debt dynamics I was seeing in Mexico, in Brazil, in the developing world were going to trigger a global financial crisis that would bring the American economy to its knees. I bet heavily against the market. I put my own money and my clients' money on the line. And then Paul Volcker cut interest rates. The market exploded upward. Everything I had predicted with such absolute certainty went precisely and humiliatingly in the opposite direction. I lost almost everything. Bridgewater was reduced to just me. I had to borrow $4,000 from my father just to pay my family's bills. I came closer than I have ever admitted publicly to financial ruin, not just professional failure, but personal destruction. And sitting in the wreckage of everything I had been so certain about, I asked myself the question that changed my entire approach to markets, to investing, and to thinking itself. How could I be so wrong? Not just a little wrong, not off by a few percentage points on a forecast. Catastrophically, completely, expensively wrong about something I had been absolutely certain about. How does that happen? And more importantly, how do I make sure it never happens again? The answer I eventually arrived at is the same answer that explains why most investors are blindsided by every major crisis. And it is not what most people expect. The real reason investors get blindsided, it is not what you think. People assume that investors get blindsided by crises because they lack information, because they did not see the data, because the warning signs were hidden or obscure or available only to insiders with privileged access. This is almost never true. The data that predicted the 2008 financial crisis was publicly available. The mortgage delinquency rates, the leverage ratios of the major banks, the structure of the collateralized debt obligations that were built on top of subprime loans. None of this was secret. All of it was visible to anyone who looked carefully and honestly at what was actually there rather than what they expected or wanted to see. The problem was not information. The problem was psychology. Specifically, it was the gap between what the evidence was saying and what the people looking at the evidence were willing to believe. After 1982, I built a principle that became the foundation of everything Bridgewater does. I call it radical open-mindedness. And it sounds simple until you try to actually practice it in the moments that matter most. Radical open-mindedness means being genuinely, uncomfortably willing to consider that you are wrong, especially in the moments when you are most certain you are right. It means building systems that challenge your assumptions rather than confirm them. It means actively seeking out the smartest people who disagree with you and genuinely trying to understand their argument rather than just waiting for them to finish speaking so you can explain why they are wrong. Most investors do the opposite. Most investors, including very smart, very experienced, very successful investors, build their worldview and then filter incoming information through it. Evidence that confirms the worldview gets amplified, evidence that contradicts it gets explained away. The human brain is extraordinarily good at constructing narratives that make the evidence fit the conclusion it has already reached. This is not a character flaw. It is how human cognition works. It is the same mental architecture that made us extraordinarily effective as a species for hundreds of thousands of years. But in financial markets, where the crowd's consensus is almost always already priced in, and where the real money is made by correctly identifying what the consensus has wrong, this cognitive tendency is lethal. The 2008 crises, what the template showed that most people refused to see. Let me show you exactly how this played out in 2008, because I lived through it on the right side of it. And I want you to understand not just what we saw, but why we were able to see it when almost everyone else could not. In 2005 and 2006, Bridgewater's research team was studying the American housing market and the financial instruments built on top of it. What we found was not complicated, it was straightforward mathematics that anyone willing to do the work could have seen. American households had taken on mortgage debt at a pace that was completely disconnected from their income growth. The loans being made were structured in ways that assumed home prices would continue rising indefinitely, because if prices stopped rising, the loans could not be repaid, and the entire structure built on top of them would collapse. And the financial institutions holding these loans were leveraged at ratios that left them with almost no capacity to absorb losses. We wrote an internal document called the D process, our framework for how deleveragings unfold, and we used it to describe in specific detail what would happen when the housing market turned. We described the sequence of events: the mortgage delinquencies rising, the CDO market freezing, the interbank lending seizing up, the Federal Reserve cutting rates to zero, and then being forced into quantitative easing. We described all of it years before it happened. And when I shared this analysis with people outside Bridgewater, smart people, senior people, people with decades of experience, the most common response was not engagement, it was dismissal. Not hostile dismissal, polite, confident, almost pitying dismissal. They had heard the bears before. They had seen people predict catastrophe before. The system had always recovered. The Fed would always step in. Housing had never fallen on a national basis. The models showed it was fine. The models showed it was fine because the models were built on the assumption that the recent past would continue. They were built on data from a period when housing prices were rising. They had never been stress tested against a scenario where housing prices fell nationally. And so they told the people who built them exactly what those people wanted to hear. This is the template of every crisis, not the specific asset class, not the specific trigger, the psychology, the gradual, comfortable accumulation of risk that nobody wants to name because naming it would require admitting that the comfortable narrative everyone has built their portfolios around is wrong. The 5 signs a crisis is building that most investors ignore. After 50 years of studying markets and living through more cycles than I can easily count, I have identified the consistent early signals that a crisis is building. These are not obscure indicators. They are hiding in plain sight in every major market dislocation in history. The reason most investors miss them is not because they are hard to see. It is because seeing them requires believing something that feels deeply uncomfortable in the moment. The first sign is when asset prices disconnect from the income streams that justify them. When you are paying 30, 40, 50 times earnings for assets based on projections that require perfect execution of optimistic assumptions with no margin for error, the risk is not in the future. It is already priced in. The future just has not arrived yet to reveal it. The second sign is when debt is being used to buy assets rather than to fund productive investment. When people borrow to buy stocks, to buy houses, to buy cryptocurrencies, not because the asset generates income that covers the cost of the debt, but because prices are rising and they expect them to keep rising, the sustainability of the entire structure depends entirely on prices continuing to rise. The moment they stop, the deleveraging begins. The third sign is when the people who should be skeptical are not. When the analysts, whose job is to stress test assumptions, are instead producing research that confirms the consensus. When the journalists, whose job is to question, are instead celebrating. When the regulators, whose job is to worry, are instead reassuring. The absence of institutional skepticism is itself a warning signal of the highest order. The fourth sign is when risk is invisible, when people talk about how much they have made without mentioning what could go wrong, when the vocabulary of markets shifts from risk-adjusted returns to pure upside, when the question shifts from what is the downside of this to how much am I going to make. That shift in language reflects a shift in psychology that always precedes a correction. The fifth sign, and this is the one I watch most carefully, is when the conventional wisdom becomes unanimous, when there is no serious mainstream argument for the other side, when the bears have been so wrong for so long that their voices have been completely drowned out, when the idea of a significant correction is dismissed not with counterarguments but with ridicule. Unanimous consensus in markets is almost always wrong, not because the majority is always wrong, but because by the time a view is unanimous, it is already fully priced in. The only direction surprise can come from is the direction the consensus has stopped considering. Why this crisis will blindside more people than almost any before it. I want to tell you something that I think is genuinely important and genuinely underappreciated about the current moment. The next crisis, whatever form it takes, whatever the specific trigger, will blindside a larger percentage of investors than almost any crisis in recent memory. And the reason is something that most people have not thought carefully about. We are living through an unprecedented concentration of information consumption. The same algorithms that determine what news you see, what financial commentary reaches your feed, what ideas get amplified, and what ideas get suppressed, these systems are optimized not for truth, but for engagement. And engagement is maximized not by challenging your existing beliefs, but by confirming them. The result is that most investors today live inside information ecosystems that are almost perfectly calibrated to prevent them from encountering serious, well-reasoned arguments for views that contradict their current positions. The bears and the bulls are in completely separate information worlds. Each is consuming a diet of content that makes their existing view seem increasingly obviously correct, and the opposing view increasingly obviously absurd. This is not how markets have functioned historically. In previous eras, you sat in a room with people who disagreed with you. You read newspapers that presented multiple perspectives. You were exposed to serious counterarguments, whether you wanted to be or not. The friction of genuine intellectual diversity was built into the information environment. That friction has been largely eliminated, and without it, the consensus can become more extreme, more uniform, and more disconnected from reality than at almost any point in financial history, right up until the moment reality asserts itself. I think about this when I look at the current enthusiasm around artificial intelligence, around American equities, around the assumption that the Federal Reserve will always be able to manage whatever economic disruption arises. These views may be correct, but the confidence with which they are held, the virtual absence of serious mainstream skepticism, is itself a warning. The one question that changes everything after 1982, after losing almost everything by being catastrophically certain about something that turned out to be wrong, I built a practice that I have maintained every day since. It is simple, it takes less than a minute, and I believe it is responsible for more of Bridgewater's success than any specific investment insight we have ever had. Every time I find myself highly confident about something, every time I feel that comfortable certainty that a particular outcome is obvious and inevitable, I ask myself one question: what would have to be true for me to be wrong? Not what could go wrong in a general sense, not a pro forma acknowledgement that there are risks. Specifically and in detail, what would have to be true about the world for my current view to be incorrect? What evidence would I expect to see if the opposite were happening? Where am I making assumptions that I have not stress tested? Whose interests are served by me believing what I currently believe? This question is uncomfortable in direct proportion to how certain you are. When you are mildly confident, asking what would make you wrong is easy. When you are absolutely certain, when the answer seems so obvious that asking the question feels almost insulting to your intelligence, that is exactly when the question is most necessary. Because that feeling of absolute certainty, that sense that the answer is so clear that questioning it is foolish, that is the feeling I had in 1982 before I lost everything. And it is the feeling that most investors have had just before every major crisis in the history of markets. I am not going to tell you to sell everything and go to cash. I am not going to tell you that collapse is imminent or that you need to take dramatic action today. Both of those responses would be the wrong lesson from everything I have just shared. What I am going to tell you is this: the time to prepare for a crisis is never during the crisis. During the crisis, decisions are made under pressure, with incomplete information, with emotions running at maximum intensity, and decisions made in those conditions are almost always worse than decisions made calmly in advance. Preparation means genuinely stress testing your portfolio against scenarios you consider unlikely, not just the scenarios you are comfortable with, not just the downside versions of your current thesis, genuinely different scenarios: a sustained inflationary environment, a deflationary debt spiral, a geopolitical rupture that disrupts global trade, a dollar crisis, a sovereign debt event in a major economy. These scenarios feel unlikely right now. They always feel unlikely right before they happen. For each scenario, ask yourself honestly, how would my current portfolio perform? Not how would it perform in theory or on average. How would it perform in the specific months when that scenario is unfolding, when sentiment is most extreme, when the temptation to make emotional decisions is highest? If the honest answer to any of those questions is devastating, if a plausible scenario exists where your portfolio loses so much that it changes your life in ways you cannot recover from, then you have a concentration risk that is not consistent with intelligent risk management, regardless of how confident you are that the scenario will not happen. Diversification across assets that respond differently to different economic environments is not a concession of uncertainty. It is the intelligent acknowledgement that the future contains scenarios you have not predicted. The all-weather approach I built at Bridgewater is not about knowing what is coming. It is about being genuinely prepared for what you do not know is coming. Hold some gold, not as a speculation, as insurance against the scenarios where paper currency credibility erodes. Hold international assets that are not correlated with the American economic story. Hold real assets that generate income regardless of what happens to currency values. Maintain genuine liquidity, not just on paper, but the kind of liquidity that allows you to act decisively and think clearly when the people around you are panicking. And most importantly, build the habit of asking what would make you wrong about your most confident positions, not occasionally, consistently, as a daily practice, because the investors who get blindsided by crises are almost never the ones who lacked information. They are the ones who had the information and filtered it through a certainty they were not willing to question. The more you think you know, the more dangerous you become to yourself. And I know this because I lived it. I was the most dangerous version of myself in 1982, certain, confident, and completely wrong. And everything I have built since then, every principle at Bridgewater, every framework for understanding markets, every dollar we have managed well, it all traces back to the humility that failure forced on me. The next crisis is out there. I do not know when it will arrive or exactly what form it will take, but I know with absolute certainty the only thing I allow myself to be absolutely certain about anymore, that when it does arrive, the investors it blindsides most severely will be the ones who were most confident it was not coming. Do not be that investor. Question your certainty, diversify your risk, prepare for what you are not predicting. The machine does not care how smart you are. It only cares what you do. And what you do right now, while the sun is still shining and the consensus is still comfortable and the warnings still feel abstract, that is what will determine which side of the next crisis you end up on.
Dalio almost lost everything in 1982 by being too certain. He used that failure to build a system that saw 2008 coming years before it happened. The difference between those two outcomes was not intelligence. It was the willingness to ask one uncomfortable question: what if I am wrong? Tell us one time when you were right or wrong about your investments. Leave it in the comments below, and I will see you in the next video.